Hopefully I can go back through this and remember
Okay.
all the things.
Yeah. Let's see. I noticed that we had Jackson on here as well. Do you have any questions, Jackson?
Honestly, no, I don't really have any questions. I mostly just came to listen to other people's questions and
Okay.
see what I could learn.
I've always
Um,
got one.
Yeah, no problem.
and
And
I also,
I usually rush through these things because I'm so excited to share my knowledge. I might, skip over some things that are important. So you have to forgive me.
I guess I do have one question. Is there like I don't really know how it works, but do you have like a study guide or anything other than the like supplementary materials that I saw were part of the class, like for the test?
Yeah, there is one study guide. Let me move this over here so I can see this. I think I put it in. Actually, where did I put this? I think somebody asked me one time, would you put this on the main screen? Oh, this was a different class. Okay, so if you go to the announcements and you do a search on study guide, it should pull it up. Oh, it doesn't. Let's see if we can find it some other way. No. Oh, come on. All right. Well, it's not there. So we'd have to go back in here. I know I put it in here somewhere. Maybe it's better if I just drop it in again. Ah, there it is.
Oh yeah, here it
In the
is.
week 10 preface, there's an
Okay.
accounting 201 guide. And you can go down to exam 4 for chapter 7 and 8. Yeah.
Okay.
And it'll walk you through the things that are going to be covered
Great.
in general.
Thank
And
you.
you can kind of test yourself whether or not you understand those concepts.
That's helpful. I knew that there was one somewhere, but I just couldn't find it, and so I just wanted to make sure I wasn't crazy.
Yeah. You're just as crazy as everybody else. So good. Yeah, so chapter 7, Carol already talked about this direct write-off versus allowance method. Right. I can make this a little bit bigger. Um, the journaling of it. I showed you the journaling of it, so that's not too bad. There's maybe some more specific ones, but that's probably the most common ones that you run into. How to compute bad debt expense. This is for the allowances. You'll definitely want to know that. And usually it's either a percentage of your total value in accounts receivable, or it's some version of the aged amount, right? So if I go back to here, and some companies, they'll take this 5,300 and let's say their experience is something like, let's just recalculate this. So they may take that 5,300 and they might times it by, let's say, 2%. Wrong, 2%. And they might come up with a number as their allowance, and then they would do the journal entry that way, right? And in this case, it looks like their allowance is more like on the order of, must be like 4%, 4.5%, or something like that, right? So that may have been how they came up with it. Who knows? Another method would be you look at your AR right here, and you'll put it in the buckets of like 1 to 30, 31 to 60, 61 to 90, 91 to 120. And some folks just go 120 plus. That's 120, 120 plus, something like that. And then they would break out their balances. So maybe you had 10,000 here, maybe 15,000 here. Let's do a sum here. So I'm at 160. Maybe they do, I don't know, 5,000 is in here, and there's another 15. Let's call it 14, just to be different. And then what's the remainder? That's 9,000. So let's say that that's how their accounts receivable is aged in terms of dates from the time that it was actually invoiced to the client. And then they might say, oh, okay, everything over 120 is what we're going to write off. And so they take this 9,000 and they'll plug it into this journal entry, right? This would be $9,000. Or the other option is they might say, well, this has got a 1% chance of not being collected. This has a 2% chance of not being collected. And let's just say it graduates a little bit more. Right. And maybe this is 10%. That might be how they do it. And so then you just take these numbers, times that, and you come up with the calculation. If I do that all the way across, then now this is what my allowance should be. So it's 2,000, right? So then I would say, okay, well, my journal entry is now 2110. And this is the journal entry you do for it. That makes sense? Did I go too fast?
I remember that being an example or a problem in that chapter.
Yeah. Yeah, they'll a lot of them will do it this route or they'll do it this way, right? Anything over a certain value is just automatically in the allowance. And then they work to try to get this all collected. So this
that
is
makes
the
sense.
type of evaluation that they'll do. Let's see. So that's how you might compute the bad debt expense and then do the allowance, the journal entry for it. So that's this right here, right? I also showed the write-off of an actual receivable, which was this other component, right? This is the actual write-off in between allowance and AR. And this is for the allowance method. This is for the direct method. How to journalize collection of an AR previously written off. So you're basically just going to go backwards depending on how you do it. Under the allowance method, it's the opposite of this, right? So if this is how you originally did it, this is the write-off, then insert. So the collection of bad debt would just be the opposite of this. So your AR would be here and copy, and your allowance would be there, and it'd just be 300 here and 300 there. Because you're just reinstating it.
Mm-hmm. And then you would have to go to the next step of the collection and crediting the AR. I mean, isn't this the two-step? If you reverse it, then you're collecting it generally, or you wouldn't be reversing it. So that takes the other two steps to record your cash in and your credit again back out on AR.
Right.
Kind of funny.
Could definitely that. Then you show the cash. That's the collection. Let's keep it here. Cash is going to be your debit, and your AR is going to be your credit.
And that kind of does tricks on you, but that's how
definitely.
it would originally have been. Yeah.
Yeah, because what ends up happening generally is you'll reinstate that invoice, which creates this journal entry. And then you would then relieve that invoice. You actually apply the payment to that invoice, which creates this entry. That's why it's really a two-step process. Yep. Let's see, what type of account? Okay, we already showed that. How to compute net realizable receivables. Showed that as well. That's this value right here. That's the net. The allowance minus the AR minus the allowance. How to compute as a percent of accounts receivable. I just showed that. How to compute bad debt using the percent of sales method. Basically the same thing, but just using your total sales values instead of your accounts receivable values. Who's a debtor and who's a creditor? How do you distinguish that? Do you know?
You owe money, you get money.
Yeah.
I don't know.
do you have a debit balance or do you have a credit balance?
Credit balance.
Right. If you personally are recognizing a credit for a balance, then you're the credit, you're the debtor. Sorry, it's just the opposite. So if you are holding a credit balance, then you're the debtor. If you're holding a debit balance, you're a creditor, right? Effectively, if you hold AR, you're giving credit to somebody. If you're holding AP, you owe somebody something.
Mhm.
Notes payable, accounts payable, salaries payable, taxes payable, anything payable, you're a debtor. Anything receivable, accounts receivable, notes receivable, anything like that, you're a creditor. Oh, good old promissory note stuff, maker, a holder, face value, stated value. This is important to double check on. There's probably only a question or two on that at most. How do you compute the annual, monthly, and daily interest? That's pretty straightforward. If you have a car payment or a mortgage payment or a credit card payment, these will be computed against you all the time. Hopefully, at some point, we all become creditors and not debtors. Interest due at maturity. So, these, maybe as an example, usually, you might have something like a loan. See, I do it in present value. Let's say it's a $10,000 loan. You got an annual interest rate, let's call it I, of 8%, let's say. And so your interest payment is just, let's say that's on an annual basis. That's pretty easy. That's just that's simple interest. And then if you had, your monthly amount, call this annual, and then your monthly, usually, and they'll catch you on this sometimes, is you have to figure out what the monthly amount is, or what fraction, especially if you're splitting years, what fraction of that 800 sticks in 1 year, and what happens, how much of it is in another year. They'll usually be testing that. They'll give you these basic values, and then you have to calculate the interest and then figure out how much is in 1 year or another. So let's say that this was issued 4/1/22, right? And so you're trying to figure out, well, what's the interest for 2022 and what's the interest for 2023? Then you're effectively going to do, that's 9 months because it's inclusive of April. So you're going to take that divided by 12 times 9, right? And this is just the difference. That makes sense?
Yep.
That's what they're going to test you on. Not only how to calculate it, but then how to split it. You usually don't get into daily numbers, but if you had to do that, you divide it by 360. You divide this by 365, right? I did this one by 12. The other option is your dailies, and they usually use a 365 as a denominator. Oops, divided by 360.
Or 360, wasn't it 360? Because it
Uh,
wasn't our normal, it isn't our normal year. I think the banker rule, they had us using, was it 360?
I usually use 365, so let's go check. That's a great question. That's my way.
Because I kept catching myself. I think it was called the banker's rule. I gotta get into the right chapter, then I can find it.
Am I in the right chapter? It looks like I am.
Hmm.
90 days, so maybe they are using 360. Let's see. Oh, this is just 90-day interest computation. Annual expresses 360. Yeah, so you're right. Good catch, Carol. They're using 360. So yeah, then just make sure you're using 360 as your denominator. That would be your daily amount.
And you don't count, I had to keep saying I had to count the days going forward, not the day that they said. I
Yeah,
mean, the
usually
starting
don't
date.
include the day of.
Yeah,
If you if for some reason that comes up, then you have to add one to whatever your calculation is, right? You just do the difference and add one. But that they don't do that on here. They typically will either tell you how many days, like 90 days, right? Or they'll tell you the difference between two dates, and then you just take that absolute difference and do the calculation.
yeah, because when you had to calculate the 60 days, sometimes they would start it like on October 6th.
Mhm.
And how many days in October, how many days in November to get your 60 days.
Yeah,
And so if it said October 6th, then you would start counting on the 7th. You never
right.
counted the day. And that was another thing I had to look up a couple of times to get it in
Yeah,
my
so
head.
I'm pretty sure if they're looking at this, they're looking at the number of days between the 16th and the 14th and splitting it out. Was a 60-day note. In the end, it's 60 days, right? So
Right.
16 to let's just test this out. So they said 12, 16, and what else did they say? 2, 14, right? So if I'm using 12/31 as my date here, that should be that minus this, and in actual value. And then if I'm using 1/1 as my start, well, actually I don't even have to do that. I just have to say plus 60 minus, oops, plus 60 minus that. Yeah, so that's how they did that,
Mm-hmm. Okay.
right? Because they split it 45. Yeah, where did it go? It's right
Yeah,
there.
that seemed like that was in quite a few different problems.
Yeah. Yeah, so they're gonna just take the absolute values in between. Basic math, no plus ones.
Mm-hmm.
Okay. Let's see if there's anything else in here. Where's the guide? Where did I put the guide? Did I open it someplace else? Ah, there it is. Okay.
Okay.
Terminology regarding, okay, we got that. We got that. Do a maturity, solve. Okay, I did that. Solve for any missing part of an interest formula.
Oh, that one I just did on pure guessing. Maybe you could demonstrate that because I would just keep plugging in numbers and I didn't know how. I tried algebra, I tried this, and then finally I just started guessing numbers
Okay,
until I got it
so
right.
this is the way I tend to do it. Algebra definitely works, right? There's another way, at least in Excel, to do it that's kind of helpful. And so I'll use the same example, but I'll assume I don't know some of the numbers, right? So let's say I know the PV, and I know the interest value, right? So I've got 10,000, and I know 800. Now you could do the math here to figure out I. You can do that divided by this, right? Okay, that's one way of doing it. So you don't know that one. So when would be a case that we don't know the rest?
Yeah, because they had some that had a a final amount, but they didn't have. Let's see. The interest is easy to figure out. They had the note value missing, and then they had the percentage missing on different
Yeah,
ones. They took all of them and put blanks in at different times.
yeah. Sorry, I was thinking of something else that would be easier. There's a function in oh shoot. let me try this. This is a test just to see if this works for you. If it doesn't, then this was, bad advice on my part. Actually, I'm gonna try this. Okay, so I have the formula in here right now. I know that the PV is 10. Let's say I don't know what the interest value is. But I don't know what the interest amount is, but it gives me 8%, right? So what I can do is I can select the percentage. I got the formula in here, right? It already takes the PV divided by, no, it takes the interest divided by the present value. You can see that. Interest divided by present value to come up with the percentage, right? So I know what these values are. So what then I can do is if I select on that, and I come up here to data, and I go over to what if, I do a goal seek. The other way of doing this, I can set that cell to, let's say they say it's 8%. And then I can change this value right here and hit OK. And what it'll do is it'll automatically figure it out for me. Do you notice how that happened? I just hit OK and it just ran through some numbers and it generated the 800. So let's say, okay, I hit OK. Let's say I don't know the present value, but I know the 800. And I don't know the percentage. I know the percentage. I can do the same thing. What if goal seek, bring this over here so let's look closer.
I have a hard time seeing that. Okay.
Oh, can you not see
That
it?
the little box is kind of
Oh, the
tiny.
little box. Sorry, I can't blow that one up.
You can't change it. Yeah.
So I set the values. It says set E13 right here to value, and I'm going to do 8%, same thing, right? And I'm going to change this value. So I'm taking E13, setting it to 8% by changing this present value. If I hit OK, ooh, what was the wrong? E13. Oh, I know. No?
You have to have a value in probably one of the two.
Yeah, I probably do. Well, I do have one in that one. It's probably because it's divisible by 0.
Yeah.
It's not working very well on this one. Yeah, it's because it's divisible by 0. So it doesn't work so well on that. So then you really just have to do straight up math. You have to, if you know this is 8%, then you have to do the math here, which is that divided by that. Right? So you just have to know how the math works backwards and forward.
So you took, so what did you divided?
So I divided the interest amount by the percent.
By the percent?
Yeah.
And that would give you the present value. Okay.
Yeah.
And then interest divided by the present value would give us our percentage amount.
Yep. Yep.
Because on one of them, I was able to just do a little algebraic thing and swap it over and boom, I had it. And then the other two, I didn't know how to do the algebra. And so then I just said, well, we'll start at this number and we'll just keep working our way up.
Yeah. So, I mean, another way
It's good to know the equation to use.
Interest.
That would save
divided
time.
by, whoops. Why is this doing this? Divided by PV equals, whoops, equals, and then you do your I%, right? Something like that. And so if you know one or the other, then you can work it out. So interest is 800, and I know this is 8%, right? So then working that out, you would, I always hate division. Always a pain in my existence.
I think don't you times it when you, like if you have to time, I can't remember what I did, but I messed around with it.
Yeah.
To get rid of a division and now don't you have to take it over to the other side?
Yeah, because this essentially looks like interest over PV, and so you have to divide PV in order to clear this out. And that's a very good question. I got to think about the math on this. I intuitively I did it, and so I got It's a good thing I'm working with my niece on some of this stuff, and so I'm brushing up on my division, my what is it? Yeah, it's division, but it's more than that. But anyway, fractions is what it is.
Mhm.
Anyway, that's going to be a brain teaser for me for just a second. How did I do it here? That was simple. I ended up taking the interest amount divided by pi.
Yeah, so when we did the interest divided by the percentage, we got the present value.
Yep, we sure did. So you're just swapping these two basically. PV comes over here, interest comes over here.
That'll give me something to think about here when I'm studying. Okay.
Yep. Okay, so that's that one. Okay, journalize issuance of notes receivable. This is all pretty straightforward. But I always say that, and I should demonstrate it. Sorry about that. I forget that I assume way too much. Usually on accounts receivable, if you're the receiver of a receivable, then effectively you're going to get cash and you're going to set up a notes payable, right? Debit, credit. So let's say it's 10,000 in cash is the note receivable, and this is the journal entry for that. This is if you're the debtor. If you're the creditor, then you're
Okay,
going
now
to
just a
have.
minute. If I'm the debtor, if
I'm
I'm the
taking on debt,
debtor,
so I've got a payable.
oh, so you got the cash on a loan.
Yeah,
Is
I
that
got
what?
the cash on
Okay,
the loan.
okay,
If I'm
okay.
on the opposite side of that coin, then it's going to be, I'm going to get a notes receivable, right?
Receivable.
And I'm going to give up some cash. So same thing, but just the opposite. So on the creditor side, going back to our early discussion, you're a receivable. You own receivables. On the debtor side, you own payables. Well, you don't really own it. You have payables. So this is how that notes receivable would generally be set up. And then you'd have your ongoing interest. And your interest would be, in this case, F4, insert. So this is issuance or receipt. And then ongoing interest would be, let's say if we go back to that interest calc, that interest at 8% on an annual basis, and let's say it's for the full year, then you would have an interest expense for that amount times 0.08, right?
Mhm.
And the opposite would be to an account. Whoops. Normally this would come out of cash. Now you might set up an interest payable in the intermediate before you pay it. Never know when you're going to pay it. Maybe it's monthly, maybe it's quarterly, who knows what. But if it might be a payable, and then later on, these are multi steps. Let's say that this is the monthly interest calc, because you're going to usually accrue it monthly. So we're going to do that, divide this by 12. So that gives us the 66 fractions, right? And then when you actually go to pay it, then you're going to hit your accounts, your interest payable and your cash. Oops. So this would generally be on the debtor side what your entries would be. On the creditor side, it'd be very similar, but just opposite. It wouldn't be an interest expense. This would be interest income. and it wouldn't be a credit. Actually, let's do it the other way around. This would be cash. No, this would be. Let's put the counts in here. They're going to be backwards though. Interest receivable, right? So let's turn these around. There we go. So you have an interest receivable that's called that you accrue, and that goes into your interest income. And then when you actually get paid, you're going to have just the opposite here as well. You're going to get paid $66 along with the actual principal. I didn't include that in here. And that's going to go to cash. And this is going to be an interest receivable against your receivable. Because you've already accrued the income.
I think they did that on one of the problems where you had to put in your payment, and so you had to put in the cash as one, and then the principal, and then the interest.
Yeah, so if I do like a payment calculator on here, equals payment, my rate's 0.08 divided by 12, and my number of periods is 12, and my present value is 10,000, then I should get, it seems about right. Yeah. If it's, is that about right?
That doesn't make sense to me.
10,438.
So 800 on the year.
Yeah, 800 a year. That's kind of wrong. I probably got this right. That's not quite right either. I'm screwing something up. 10,000.
Well, I think it would just be your 10,000 plus your 800 is what I recall them doing. You just have to have an entry for the total cash, like 1,000 to 10,800, and then an interest receivable.
This is compound interest, so we'll just ignore that.
Oh, okay. That could be what it's doing.
Yeah, so monthly interest calc is here. That would be fine. And it might go, if you're accruing it to the notes payable, you might just go ahead and do it too, but we'll just do it to interest payable. And then the payment would come out of here. Notes payable would be a debit. And so let's say that it's just 1/12 of that number is what they're paying.
Oh, yeah, the 1 monthly payment.
Yeah, so then we just take these two values.
And there's your cash.
Right, there's your cash. So this is the full kind of inclusive of the actual principal payment. And then this one, your interest calc's the same. All you're doing here then is your notes payable is going down by the same amount.
Mhm. But all these steps do help me understand what is going on better in the accounting process, when it comes time to put them
Oh
in.
yeah, that's good. Oh, that's because it's doing
No,
that.
that's not.
You gotta unlink that. There you go. So that would be the full transaction cycle for the creditor, and this is the full one for the debtor. That makes sense? Jackson, you follow?
It does.
I'm not going too fast, hopefully.
I just have to remember it.
Yeah.
And I know they did the turnover of receivables, and they did the turnover of sales. I know that they had two different.
Yeah,
You just changed.
this always honestly trips me up as well. So AR turnover and oh yeah, this is an AR turnover calculation. So on those, you're really dealing with a couple of accounts, right? One is your sales or your revenue account, and then the other one is your accounts receivable balance, right? So let's say, and I'll walk you through this like how I usually think of it, which is always strange, but it's a little bit different than the book. So let's say I'm doing $10 million a year. Let's see if I can get these numbers right. So let's say I'm doing $10 million a year in sales, okay? And I've got $500,000 in AR. So the question is, what's my turnover? How many times, and this is day sales, this is terms of days, I think, of the way we used to calculate it. So really and is this on a 365 or a 360?
I think they did everything on 360. I don't think they did anything on 365.
Let's go back to that. Let's see what we got here on a turnover. Receivable turnover. They're doing it on millions.
So net accounts receivable turnover was net sales divided by average accounts receivable net.
Yeah. So not even worried about, okay, so I was doing day sales. All right. So let me not confuse this then. So you have your beginning. This is on AR, right? Average AR. Yeah.
Average accounts receivable, which I think we had to take the 2 years.
So you usually have a beginning and an ending,
Yeah.
right? So let's say this is 750, right? So you're going to average this. Oops.
Two.
I need a little bracket in there. Okay, so there's my average, right? So my turnover is that divided by that. So once I get it set up in Excel, right, if I do this, then anytime these numbers change, then it's pretty easy. You might have a couple of different examples, right? And you get your turnover values. So total sales or net sales divided for the year divided by your AR.
Average. Yeah.
Yeah, your average AR. So that's how I would probably set it up. So it's pretty straightforward. Put your sales in, put your beginning and ending, create an average, and then do the calculation. Okay. Let's see. What else we have here? AR turnover. Okay, your single step and a classified balance sheet that includes AR. Let's see if we can see that in here. Oh, I'm at time, but that's okay. Finish this up. Oh, okay. Where do they have the balance sheets and income statements? Let's try there. Yeah, this is definitely good to go through. This cheat sheet. Let's see if there's any, where's those statements? It's easier for me to show it than to create it.
Right. I was just looking through that. I'm not seeing. I thought they had a sample in here. Oh, there it is back. Well, no,
No, it's not. Yes, it is.
that's accounts receivable. Let's see.
Oh, interesting. I don't see where they show this, but let's see if we can find it. It's gotta be here somewhere.
I wonder if it was in chapter 8. Maybe not.
Well, it's showing it in chapter
7.
7, right? As a need to know. No. Huh. That's interesting. Not really showing it. Yeah, they're not showing it very well. So let's go back here and let's just see what. Oh, sorry. Running all over the place. Okay, so what ends up happening? Let's go here. Single step income statement that includes interest revenue or interest expense. So let's see if maybe the easier way is. So I don't have to kill you guys on this. See it. So here's your interest expense single step. Right? Interest expenses within expenses and interest revenues are up on top. Single step.
Yeah. Interest always, those expenses always goes down into the
Yeah. Now there's
bottom.
the other a multi-step option will combine the interest revenues and interest expense in an other category. Right. And so it's going to look more like, see if I can find it. That's not very good. I think there we go. It's going to be more like this, where your interest expenses are in here under other. This is the net value. And then on the balance sheet, what were they looking for? On this one, you just have your AR all netted out here. But on a one that shows it without the net, it's going to usually, let's see. Where's my version with the allowance? There we go. So you'll see the allowance here, and then a note for less allowances, and then a net right here.
Yeah, I think that's what they did on the last
Yep.
quiz thing. It would net it out. Yeah.
Yep. So this is referring back to here. That includes receivable reflected net of the allowance for doubtful accounts. So those are your two options, really. This way or just netting it all together.
And the form that you get usually they have the drop downs that kind of gives it away, what you need to do.
Yep, yep.
Okay, well,
Okay.
7 was definitely more difficult for me than 8, so that's where my time's probably gonna go, hopefully, and.
Yeah, and it's the
all
one that
back
you did last week, right? Not this week, so
Right.
it'll be less familiar to you. Definitely